Today we are going to cover financial reporting FR, or formerly called F7. We'll take a question from the sample question from March, July 2020. Let's go to the question. We'll take scenario 2, that is blank core. Let's go to the required. A. Prepare the consolidated statement of profit or loss and other comprehensive income of blank core for the year ended 31 December 20x8. B. Calculate the carrying amount of the investment in ACCA in the consolidated statement of financial position as at 31 December 20x8. That's 2 marks. The statement of profit or loss is for 18 marks. So there is more work to do there in the consolidated statement of profit or loss. Now let's go to the scenario. I assume everyone has downloaded the question from the ACCA global website, then read the required and also have read the scenario. Now, Blanco has owned 35% of ACCA since 1 June 20x7. This means ACCA is an associate of Blanco. Blanco doesn't control ACCA because he only owns 35%. And it acquired 85% of Strip Co on 1 April 20x8. Now, Strip Co becomes a subsidiary because the ownership of its percentage is more than 50%. The statement of profit or loss and other comprehensive income for the year ended 31 December 20x8 are Blanco, the parent, Strip Co, the subsidiary, and ACCA, the associate. Now, please take note of the timeline. Our reporting date is 31 December 20x8, which means the beginning of this year is 1 January 20x8. But now, Strip Co was acquired midway in the financial year. It was acquired on 1 April. So we need to prorate everything that is on the statement of Strip Co. And also when doing the consolidated statement of profit or loss, we will not consider ACCA, as ACCA is an associate. So we will not be adding the figures for ACCA. Now, let's go to the notes first before we do our consolidated statement of profit or loss. Now we are given here, note number 1, a fair value exercise conducted on 1 April 20x8, which is the date of acquisition, concluded that the carrying amount of Strip Co's net assets were equal to their fair values with the exception of an item of machinery which had a fair value of 8 million in excess of its carrying amount. At 1 April 20x8, the machinery had a remaining life of 3 years. Depreciation is charged to cost of sales. So we are told here that excess depreciation, we should post it to cost of sales. Now let's do our workings. Note number 1 here, we've got FVA on plant. We are told that the plant at acquisition, I will be working in 1,000, it's 8 million. So I will say 8,000 like that. Then it had a useful life of 3 years. So now the depreciation will be 8,000 divided by 3 years. But we need to prorate from April, May, June, July, August, September, October, November, December. for 9 months. So multiply by 9 out of 12 months. So the excess depreciation becomes what? 2,000. This is excess depreciation that we need to post to the cost of sales. Now we are done with note number 1. Now let's go to note number 2. Since acquisition, Plantco sold goods to Stripco totaling 39 million. So we've got intra-group sales, of which they are 39 million. I'll say 39,000. We need to reverse or eliminate this from sales and also from cost of sales. Stripco had 1/4 of these goods in inventory at 31 December. The subsidiary had 1/4 of these inventory. So now we've got PAP on closing inventory. We are told that during the year, Plantco also sold goods to ACCA for 26. This is an associate, all of which ACCA held at the end of the year, that's 31 December 2018. All of these goods had a markup on cost of 30%. So now, PAP on 39,000, we are told that Stripco had 1/4, so we divide by 4. That's 39,000. Then we multiply by 30% divided by 130. So the PAP on Stripco's books is 225. Then let's calculate again the PAP now on ACCA's inventory. We are told that the inventory that was sold was 26 million, I would say 26,000 multiplied by 30 divided by 130, like that. So the PAP on ACCA was 6,000. We are done with that. Now let's go to note number 3. The investment income of Plantco for the year ended 31 December 2018 includes dividend from Stripco and ACCA. See note number 4. It also includes 5 million interest receivable on a loan made to Stripco on 1 April 2018. So this interest, we need to reverse this interest as this is an intra-group transaction. Right, this interest, where is it? In Stripco, this interest is here in 14,000 as finance cost, and also in Plantco, the parent, the interest is here in investment income of 46,000, and also the dividends from Stripco and the ACCA are also included here under this investment income of the parent Plantco. So we need to reverse all of those. Now let's go to note number 4. Note number 4 says Stripco paid a dividend to shareholders of 18,000 on 31 December 2018. ACCA paid a dividend on 31 December 2018 of 35 million. So now let's deal with dividends. Strip paid a dividend of 18 million, of which the parent owns 85%. So we'll say 18 million multiplied by 85%. We get 15,300. Then of ACCA, the dividend is 35 million. of which the parent owns 35%. So we'll say 35 million multiplied by 35%. So that is the dividend. So these two dividends will be removed from this 46,000 investment income, as we do not want to show the intra-group transactions in the statement of profit or loss. Now let's carry on. In note number 5, in plain cost consolidated statement of financial position, the carrying amount of plain cost investment in ACCA was 145,000. There was a typing error here. It was supposed to be 145 million, which makes it 145,000 in thousand. This was calculated using the equity accounting. We'll come back to this one. All other comprehensive income occurred after 1 April 20x8. So let's go here. All other comprehensive income, we've got gain on revaluation of land. So this gain of 3,000 and this one of 2.8 happened post acquisition. So happened after 1 April 20x8 to 31 December 20x8. So after post acquisition, which means we do not need to split this in terms of 3 months and 9 months. So this occurred in the post acquisition period in those 9 months. So we will not be splitting the 3,000. Now, all items in the above statement of profit or loss and other comprehensive income are deemed to accrue evenly over the year. We have already assumed that we will split everything 9, 12, 9, 12 as they are accruing evenly. Now let's do the statement of profit or loss. Now the statement of profit or loss. We will start with revenue. Revenue we take for the parent 705,123 plus 9 over 12 multiplied by 218,000 less this 39,000, less 39,000, the intra-group transaction. So we'll say 705,000 705,000 plus 9 divided by 12 multiplied by 218,000 less 39,000 intra-group sales. We get that figure. Then we come to cost of sales. The cost of sales will do the same. We'll say 320,000 of the parent. We add 9 divided by 12 multiplied by 81,000 of the subsidiary less 39,000 intra-group transaction. We should also less add the PAP of 2.4 for 2.250 for strip, and we should also add the excess depreciation, as we were told that the excess depreciation needs to be charged to cost of sales, like that. Now let's do our calculation here. Our calculation here will be 320,000 of the parent. We also add on top of that 912 of 81,000. Then we will less 39,000 intra-group transaction sales add 2250, the PAP on closing inventory of strip. We'll also add 2000. Also add 2000 the excess depreciation. We get 346,000. Then when we sum up this, we should be getting gross profit. After getting our gross profit, we go to distribution costs. Our distribution costs for the parent, we have got 58,000 plus 9/12 multiplied by 16,000 of the subsidiary. We are not taking anything for the associate. We get that figure. Then let's go to admin expenses. Admin expenses, we also take the whole of this parent. We add 9/12 of the subsidiary, which is 28,000, like that. We get that. Then we come to investment income. We said under investment income, there are a lot of adjustments here. Under investment income, we have got 46,000. We will add 9/12 multiplied by 2,000. Then we will less 15,300. That is the dividend from strip. We will also less 12,250. That is the dividend from ACCA. We will also less the 5,000. That is the interest on loan to strip. Right. Then from here, we will say, sorry about my space here. Here we will say 46,000 of the parent. We add 9/12 multiplied by 2,000 of the subsidiary. Then we less 15,300, the dividend from the subsidiary. We less 12,250, the dividend from the associate. We less 5,000, the interest from the subsidiary. We get that figure there. Then here, before finance cost, let's have the share of associate. Right? Associate made a profit of 92,570, but there was a PAP of 6,000. So let's say 92,570 minus PAP of 6,000, all multiplied by the share of the parent, which is 35%. That's what we will do here. We'll say 92,570 less the PAP of 6,000 all we multiply by 35% of the parent, like that. Then we get 3,300. Then from here, let's go to our finance costs. Our finance costs, we take 12,000 for the parent, we add 9 out of 12 multiplied by 14,000 of the subsidiary, then we less 5,000, that the interest that was paid to the parent. So let's do that here. 12,000, 9/12 multiplied by 14,000, then we less 5,000. We get that. Then from there, we can sum up everything from gross profit to get the profit before tax. So we get here profit before tax. Then we have our tax here. Our tax here is 51,500 for the parent. We add 9 out of 12 of the subsidiaries, 15,000. Then we come here, we say 51,500 of the parent. We add 9/12 of the subsidiaries, 15,000. We get that. Then we sum everything to get the profit for the year. Then from there, other components, we've got gain on revaluation of land. Here we add 2,800 plus 3,000. We are not apportioning the 3,000 as all 3,000 is post acquisition. So 2,800 plus 3,000, like that. Then when we add again everything here, we will get our total comprehensive income. Like that. Then here we need to split the profit for the year and also split the total comprehensive income. So profit for the year is this figure, attributable to we have the NCI, we have the parent. Here the NCI, we will need to calculate their share here. How do we go about that? We have the total profit as 66. So we'll say 66,000 multiplied by 9 out of 12, then less the PAP of 2,000. That is excess depreciation, all multiplied by the percentage of the subsidy of the NCI, which is 15%, like that. So it's 66 this profit 9/12 of this one less this excess depreciation of 2000 multiplied by 15%. Let's do it here. We'll say 66,000, that is the profit for the whole year, multiplied by 9/12. Then we less the 2000. Then we multiply everything by 15%. That is the percentage of the subsidiary. We get that figure. So the difference between the profit for the year less the profit attributable to the NCI, we get the profit attributable to the parent, like that. Then like that. Then from there, we need also to share the other comprehensive income, total comprehensive income, of which is this figure. Then we need to share it again between the NCI and the parent. Now, how much are we sharing to the NCI now? We are sharing to the NCI hold now we are sharing, as usual, 66 multiplied by 9/12 less 2000, then add the 3000 revaluation reserve, then all multiply by 15%. So let's do it here. We have got 66,000 here multiplied by 9/12 less 2,000. From here, inside the bracket, let's add 3,000 revaluation. So the NCI will be 7575, and the profit for the parent is automatically calculated as 263,725 to balance off to 271,300, like that. This is what was required from us to get this 18 marks here. Now let's not leave marks hanging. We have got the last question here, say calculate the carrying amount of investment in ACCA in the consolidated statement of financial position. So we need to calculate the associate figure in the statement of financial position. The associate is ACCA. Now let's go here. Let's say opening balance. We are given the opening balance here under note number 5 here. The opening balance is 145,000. Now we need to add something here. Here we need to add the share of profit. We have calculated this figure. Do not calculate the same figure twice. The share of profit, we have the share of profit here is 3,300. Then from here, we have to less the dividend. The dividend, the total dividend, we have it here, is 12,250 attributable to the parent. So we do not need to calculate this one. We'll come here and say less that dividend attributable to the parent, which is this one. Then from there, we need to sum up. When we sum up like that, we get that figure that was required for us to get these 2 marks here. So please watch this video time and again, pause it here and there slowly, try to digest what I'm saying, and after that you will be able to answer the similar question in the examination. Good luck in your exam preparation, and thanks for watching. And if you have not subscribed to my channel, please do so now. Thank you.